You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we're in earnings season, and with that said, we had the mega cap tech all announced earnings last week. There were it was probably the biggest week as far as earnings are concerned for this quarter. We had Google, we had Apple, we had Amazon all announced on Thursday after the close last week. We taped Options Playbook Radio on Wednesday after the close, which was February 1st. And we looked at a Christmas tree put butterfly in Apple, implying that we were going to be bearish on Apple. We talked a little bit about that trade. Now, the downside of the trade is that we taped on Wednesday, and going into Apple's earnings, we did have a rally on Thursday. So at the end of the podcast, we just talked about the fact that most of the time, if you're doing something around earnings, you don't want to put the trade on until closer to the earnings announcement, i.e. at the end of the day on Thursday. But with that said, we taped when we taped. And when we did that, Apple was trading at 145.43, which was Wednesday the 1st, and the markets were closed. And we looked at doing a Christmas tree butterfly, which means we bought the 140 put, meaning that we really wanted the market to get down to at least 140. We sold 3 of the 136 strike puts and then bought 2 of the 134 strike puts. And that was our hedge. That's what protects us. So 1 by 3 by 2, the February 3rd expiration. So this was 100% a speculative trade just based off of earnings. Little bit of frothiness since the beginning of the year in some of the mega cap tech stocks, and just looking for a little, buy the before the event and sell after the event. And that was kind of what we were hoping would happen. Expected move was about $6 to the downside. So on Thursday, the markets were pretty wild as far as what was a strong move to the upside on Apple. So Apple went from 145 and ended up closing on Thursday before the announcement on the 2nd at the close was 150.82. So we had a 5-point move to the upside, which is basically what the expected move was anyways around earnings. So I definitely would have adjusted the trade. After the earnings announcement, Apple reacted in the after-hours market poorly and was actually down for a good part of the after-hour session about $6, which was the expected move, which is what we were really hoping for on Apple. But the very next day, it did not stay down for long. The market actually rallied, and the Christmas tree butterfly really didn't have a chance, especially at the strikes that we talked about on Wednesday when we set up the trade. So good news about that is that we only risked 34 cents. That means $34 plus commission to put on that trade for a 2 by 3 by 1, or you could say, I guess, a 1 by 3 by 2. It kind of rolls a little bit better. Butterfly, but we had limited risk because we were protected 100%. The net debit that we paid for it was the maximum that we could lose on the trade. So we really just needed the market to open down, and you had 1 day for it to trade, and just trade between the strikes, which is from 140 to 134. Very speculative trade, and it did not work out. That simple. Okay, so let's keep with the theme. We're going to look at a momentum trade this week in Snap. Now, Snap is, a little bit nervous in that they had their earnings report. We've got some momentum from their earnings report. They came all the way back to their lows prior to the pandemic and bounced a little bit and have had, if I look at the actual chart here, we have like 1, 2, 3, 4, 5, 6, 7, 8, 9 up days in Snap. So this literally is going to be a momentum trade. And we don't talk about momentum trades based off of a chart that often. Actually heard about this, just the stock in general from a chartist that's on CNBC a lot. And the momentum is obviously there. Do you want to try to ride the momentum? How would you speculate on a trade hoping for a breakout to the upside? And with Snap, we just don't talk about it that often. So we're going to actually look at buying an out-of-the-money call option with limited risk. And you would decide the leverage. Would you buy 1, 2, 3, 4, 5 of these things? It's based off of how bullish you want to be on the underlying stock. And once again, as always, this is not meant to be a recommendation. We're just trying to learn on Options Playbook Radio. And the biggest thing that we really want to do is try to diversify with the strategies that we pick. So I don't see many opportunities, or that's just not the way that I trade, in that I'm speculating just based off of a chart move and a potential breakout in a stock. It's just not the way I will usually trade in my portfolio in general, but I do see this as an opportunity. It's an inexpensive stock, and so that will make the option contracts fairly inexpensive and make it simple to speculate on a breakout in Snap. Just based off of the chart. So that simple, that easy. It's going to be a quick Options Playbook Radio this week. So if I'm buying and I'm speculating on an out-of-the-money option contract, what would be some of the rules that I would use when I'm considering that trade? If I'm out of the money, first of all, one of the things about out-of-the-money option contracts, I like to err on the side of buying too much time. Now, Snap has extremely high implied volatility. Even though they've already announced earnings, we still have high implied volatility. And that's a scary thing about Snap, is that there's some frothiness that's in it. So the options aren't cheap. And you might consider just doing a long call spread because of that. But my attitude is going to be, I'm worried about fluctuations in implied volatility, which also means you're going to be a little bit worried about time decay because you're going to have some juice in these option contracts. So I'm going to err to the side of going a little bit further out in time. Even though I don't want to be in this trade, let's say for 40 odd days, I just want to go further out in time, go a little bit out of the money. If you go further out in time, here's the benefit. You get a little bit higher delta. The option will react a little quicker. Delta increases on out-of-the-money options when you give it more time. More time means there's a higher probability of the stock reaching that strike price And that fact is reflected in the delta. Also, you have a slower rate of time decay. Each day that passes, you're not on that exponential part of the curve where you're going to get every day is going to take away a big chunk of the out of the money premium on the option contract. So you get a slower rate of time decay by going further out in time. You get a little bit higher delta. It means that the option will react fairly decent to a 1 point movement in the underlying stock or even a half a point movement. But the downside is you got to pay for it. It's going to be more expensive to get those benefits by going further out of the money and going out farther in time. So where's the magic date? Well, in my idea here, I would be looking to be in this trade from 7 to 10 days. I'm going to buy a 38-day option contract. The implied volatility on the March 17th, which is the normal monthly expiration, it's the third Friday of the month in Snap. I like to trade in those expirations because they usually have more open interest, more volume, just a little bit tighter markets. And the markets in Snap, even with high implied volatility, are penny wide on almost all the option contracts. So that's very solid, if you will. And we're going to spend about 50 cents on this. We're going to look for a strong move in Snap. And like I mentioned, the options are expensive. So we're going to look at the 14 strike with Snap trading right now. The markets are open and rocking and rolling. And by the way, we're taping on a Tuesday this week. So we're going to be changing it up here on the schedule as far as the podcast is concerned. So it's Tuesday, February 7th, and the markets are open and rocking and rolling. I took a snapshot of Snap. Pardon, that's kind of fun there. But I took a snapshot of Snap right now, and based off of that, with the markets rocking and rolling, it's 12.24 up 17 cents. So it's good that the momentum is still going, and that's kind of what we'd like to see here. And we're kind of hoping over the next week that we will still get some of this momentum and literally get a breakout to the upside and make these option contracts become in the money options as opposed to out of the money options. If I'm buying an out of the money option contract, I got to believe that it can get to that strike. If I don't think it can get to that strike, well, then I'm not going to do that trade. So this one is a little tough one because 14 on a 12 from 12.24 to 14 on a low price stock like that is a very high percentage. So we're talking about $1.75 is the type of move that we're looking for on a $12.24 stock. So we're looking at like a 14% move to the upside for this trade to actually reach that strike. So if you don't think it can make that type of move on the breakout, then you just don't want to do the trade. It has made that move recently, and it's a little bit gives it a little bit of a headwind to the upside. But I'm still going to look at the trade. So outlined all of the things that I would be interested in. Part of the reason why I'm doing the 14 strike is that the options are expensive and I don't want to risk a lot of capital. The 13 strike call, which is 75 cents out of the money, is trading for 85 cents. Now, if I were to use that strike, and I would maybe consider doing buying the 13 and selling the 15 and spreading the trade off. Now I would go a little bit closer on the expiration than I would now by buying the longer term option. That gives me that slower rate of time decay. The delta on the option would be 33, implying that if the stock went up 1, this should go up 33 cents on a percentage basis. That's pretty good. So that's why we're doing the trade, and that's why we're picking that option contract. Okay, so here's the official paper trade for the week. A momentum trade on Options Playbook Radio. Actually looking at buying out of the money call options. Happens very infrequently. We're doing it after earnings. So implied volatility actually is lower than it was prior to the earnings report. But right now it's trading at a 72% implied volatility. The delta of the option contract is 33 cents. The market is 54 cents by 56 cents. So we're just going to buy it on the ask of 56 cents. If we buy one contract, that means our total risk is $56 plus commission. Looking for a breakout on snap on the chart. Not meant to be a recommendation, as always, here on Options Playbook Radio. We're just trying to look at the conditions of a marketplace and take a play from the playbook that might meet those conditions and talk about how we would select the strike and the expiration. That's it for this episode of Options Playbook Radio. If you have any questions you'd like to ask me, you can send them directly to me at theoptionsguy@invest.ally.com. If you want to learn more about all the things that we do here at Ally Invest, please follow me on Twitter. My handle is extremely simple. It's at my name, at Brian Overby. And we'll see you same time, same place next week. Until then, may all the options that you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.